Good morning to you all and welcome to this conference on the future of finance on behalf of the International Monetary Fund. I am José Viñals, the Financial Counselor of the IMF. And you may wonder, why is it the fund organizing a conference on the future of finance? And let me tell you, in response, that finance is a very central part of what we do. Finance is a key part of our multilateral surveillance, and as you may know, on the occasion of the annual meetings and the spring meetings, we publish our assessment of the global financial situation in the Global Financial Stability Report, where we identify the key risks to financial stability and we make a number of policy recommendations. The IMF is also regularly engaged with global financial standard setters and with the Financial Stability Board in the development of global regulation and also in the assessment of the economic impact of that regulation. And in terms of our bilateral work with countries, we do financial sector assessment programs, which are in-depth checkups of the health of national financial systems, and through technical assistance, surveillance, and our involvement with crisis countries, financial issues are certainly very central to our work. This is what justifies that we have organized this conference on the future of finance, where we do not only want to take stock of where the financial system is now, more than 6 years since the beginning of the global financial crisis, but mainly look forward and ask the question, where is the financial system going in the post-crisis environment, in the new regulatory environment? Where is it likely to be 10 years from now? And for that, we have tabled 4 key issues for discussion. The first one, ethics. How big are ethical problems in the core of our financial system? And what can be done effectively so that ethical behavior is at the center stage of finance, and it's an integral part of financial culture. How to ensure that people do the right thing even when no one is watching. Second, the role of banks. After the crisis, where banks had a huge loss in terms of money, but also in terms of public confidence. After the crisis, where banks have to face a new regulatory environment, are banks in retreat? Will they come back? What is the future of banks? Third, the role of non-banks, what some call shadow banks. Can they really occupy the space that banks are leaving free in the provision of financial services to the economy? And what risks do they entail, and what's the best way of dealing with those risks? And last, technology. Technology is affecting our lives. It's affecting finance. It will affect finance even more going forward. So what changes are they likely to happen in the financial system as a result of technological innovations over the next 5 to 10 years, both in advanced economies and in emerging markets and low-income countries where financial inclusion is the most important issue? To help address all of these questions, we have assembled a superb group of speakers coming from the private sector, from academia, and from the official sector, both national and international bodies. And we even have the church joining in this discussion, as you will see in a few minutes. And to help frame the discussion, David Lipton, the first Deputy Managing Director of the fund, is going to provide the opening remarks. And then we will go straight into the first session on ethics and finance. So let me call for David to come to the floor. Thank you.
Morning, everyone. Let me say a few words of welcome and introduction to our conference. I'm really pleased to be here among this very distinguished group of leaders from the world of finance. The future of finance is a fascinating topic, and in fact, we've been talking about it all week. And it's one that's central to the evolution of the global economy in the coming years. The financial sector is bigger, its reach is broader, and the world's become more interconnected than ever before. That brings with it some potential that global interconnectedness can fuel growth in advanced economies and convergence in emerging market countries and developing countries. But it also brings with it the risk of more accidents along the road. One of the key roles for us at the IMF is to help maximize the upsides and limit the downsides of that challenge. And we aim to try to help make the world safe for interconnectedness. The question is whether we all in our community are ready to sustain the commitment to interconnectedness. And here, when I say we, I mean all of us, policymakers, regulators, supervisors, financial institutions, investors large and small. Today, we start off with a debate on one aspect of the future of finance, the ethical underpinnings. I suspect we'll come out of today's conference with more questions than answers, but I think that's fine, as long as we continue to work together to seek those answers. I'm very impressed by the topics that are going to be discussed here today, and glad that we have such an experienced group of speakers to be before you. I want to thank everyone on behalf of the IMF for spending your Sunday with us to exchange views on this subject. We all acknowledge that it'll be hard to have growth and development without finance. We're also clear that various building blocks need to be in place for growth-enabling finance, well-governed institutions, well-supervised institutions, and individual and corporate integrity and accountability. Progress has been made in building these foundations, new rules for banks, a new focus on governance, and a renewed attention to enforcement of the rules. But one element may be missing, the mortar to hold it all together, namely the commitment to a behavioral change that will underpin confidence and trust. So let me take a moment to focus on why the IMF strongly supports a discussion of ethics in finance. This is not a soft topic. I think it goes to the heart of financial stability. In 2008, we learned the hard way that confidence in markets and institutions and trust among market participants is the very essence of a well-functioning financial system. Now, we all realize that governance and incentives have to be well aligned with ethical and responsible behavior in order to support strong institutions and resilient markets. But the culture of finance is also important. We saw that what happened when confidence collapsed at great economic and, more importantly, a social price, and we're still living with the fallout of that experience. Now, as we emerge from the crisis and search for policies that will put economic growth on a sustainable footing, we must ensure that there's no place for reckless risk-taking that can threaten financial stability and sustain growth. In the immediate term, we need to build firm foundations for the future. This means facing the legacies of the crisis head-on, cleaning bank balance sheets, addressing asset quality problems, and adjusting business models, both from a risk and a return perspective, delivering tough supervision and credible enforcement. It also means that understanding the ramifications of the changes that we've already put in place and the responses that we're going to continue to see. I think that agenda requires ambitious leadership from the financial sector and policymakers, international coordination and cooperation, and political support. The alternative to pursuing this agenda is to allow reform fatigue to set in, to lose momentum, to risk losing the gains that have already been made. This path of least resistance could bring some short-term gains to some market participants, and it's tempting to go that way as growth still eludes us. But I think that such a path is not a sustainable one. Without addressing the fundamentals, we're likely to end up once again in a place that we don't want to be, with excessive risk-taking, poor internal governance, weak underwriting standards, misaligned incentives, mis-selling of complex products. Repeating the mistakes of the past would ultimately inflict more lasting damage on confidence and trust in the economy. As our Global Financial Stability Report made clear last week, we're witnessing a return of risky behavior in markets. Asset valuations are at historically high levels. Spreads and volatility are at all-time lows, suggesting that there may be mispricing of risk. This likely comes from a coincidence of two developments: unconventional monetary policy, which has created a low-rate, ample liquidity environment, and the financial and regulatory agenda. Progress on the financial and regulatory agenda has no doubt made banks safer, but it's also changed their business models. There are some, maybe many activities that banks will no longer take on. Of these, some will migrate to the non-bank sector, but some won't get done. For those that won't get done, we need to ask whether that matters for the real economy, and if it does, what to do. For those that shift to the non-bank sector, we need to ask, will these activities be done safely or unsafely? In principle, of course, the non-bank sector can provide intermediation and do so without dangerous maturity transformation and leverage, and thereby make a very important contribution to intermediation and global resource allocation. But in practice, we fear that some risky behavior is merely moving to the non-bank sector, in a sense, into the shadows. All of these dimensions need to be considered and better understood. Now, to be clear, we're not suggesting that the financial and regulatory reforms should in any way be rolled back, but rather that we need to be thoughtful about their implications and how to manage those consequences. I'm aware that there's concern in the industry about the ongoing reform agenda and the potential for long-lasting and adverse implications. We're certainly still in a challenging transition phase where the adjustment of bank business models is difficult, as I just mentioned, and uncertainties on some important initiatives remain, making business planning difficult. I look forward to hearing from our industry participants on this topic. I also hope that discussions such as these will help serve as a catalyst for policymakers to get on with resolving remaining uncertainties. Now, I urge practitioners and policymakers here, be bold in your thinking and try to find ways that we can together move forwards towards a more stable financial sector. Looking over the medium-term horizon, if we are to succeed, it will be strong regulation and supervision and our shared commitment to doing things differently that will put in place the financial stability needed to sustain growth. I also see a changing landscape as an opportunity for market participants, banks and non-banks alike, to be at their creative best. New technologies reduce costs and open up competition, and new competitors may rise up to offer new and innovative services and channels of finance. They have the potential to widen access to finance for the whole of society and for poor societies. Greater transparency brought about by technology means better prices for customers and new opportunities for business. The best example, most recent example, of course, is mobile banking, which has been phenomenally successful in some region and is driving a lot of financial inclusion. Another example is new trading technologies that reduce barriers to entry, enhance market liquidity, and have the potential to improve market functioning. There are, of course, some new risks. New technologies, by their nature, are disruptive. We need to understand these and monitor them. Cyber risk was a term that few used 10 years ago, and now it's on everyone's mind and in the headlines just last week. In this area, we need to ensure that the issues we think about are sufficiently broad. Cyber risks relate not just to the realms of infrastructure integrity and national security, but also to the economic and financial realm. Economic policymakers need to talk with their colleagues in their national security and law enforcement spheres to ensure that all aspects of these new issues and all priorities are properly set. As new technologies are adopted, there's a potential for market disruption, for winners and losers in the established financial system. This means that demands on policymakers and supervisors will only increase. These changes need to be managed carefully, given the pervasive role of finance in the modern society. All of this, what I've been talking about, these are daunting challenges, but there are opportunities that we all can take advantage of. today's discussion and a continued dialogue among all stakeholders are crucial to gaining a better understanding of the momentous changes that are before us. That will help build the policy frameworks needed to support finance in the future so that it can continue to be an engine of growth. It will help us to achieve a new momentum. Making the right choices now should allow us to put in place a sound foundation for an ever more stable financial sector. Thank you. I look forward to hearing the discussion today.
Good shape?
So far, so good. Haven't done anything wrong yet.
So good morning. My name is Sean Hagan. I am the IMF's General Counsel, and I will be moderating the first panel discussion this morning entitled Finance and Ethics. And if I can invite my panelists to join me, hopefully they will.
Yeah,
you're right here.
Oh, did we miss something?
Yeah, no room at the end. You have to sit next to me, Christine. Yeah. There we go.
Excellent. So, although I'm sure that the people on the stage are well known to you, allow me to introduce them. Starting from my far left, Philip Hildebrand, Vice Chairman of BlackRock. Kok Song Ng, Chair of Global Investments at GIC. The Most Reverend Justin Welby, Archbishop of Canterbury. Christine Lagarde, Managing Director of the IMF. And Mark Carney, Governor of the Bank of England and Chairman of the Financial Stability Board. So I'd like to kick off our discussion by sharing some results of a survey that was conducted by the Economist Intelligence Unit last year on the subject of ethics and the financial services industry. Now, out of 18 different industries, the financial services industry was judged by the general public to be the least trusted to do the right thing. Now, I should note that my own profession, the legal profession, was not included. And I have a sense that if it had been, it would have competed for last place, at least in this country. At least in this country. But perhaps more troubling, based on a poll of almost 400 financial services executives from around the world in this survey, over 50% of them stated that their own career progression would be difficult without being flexible with respect to ethics. So, Philip and Kok Song, if I could begin with you. Both of you work in or closely with the financial services industry. 50%, over 50%, say they needed to be flexible to sort of be successful. That's a frightening figure. Does it surprise you? To what extent is this a problem that's always been plaguing the industry? Or to what extent has there been a change in the last 15 years, 20 years in behavior? And if so, what's been driving that change? Philip, perhaps we could start with you.
Thank you, Sean, and thank you for having me here today on this great panel. I think we need to begin with an initial observation and a fact, namely that finance, banking, and ultimately financial transactions are special. They have a special place in a modern economy and have had a special place for a long time. I think, we may like that or not like it, but it seems to me that that's simply a fact we have to recognize. What the great financial crisis has done, I think, is to make that fact apparent to everyone all over the world by virtue of the disruption it caused, but also by virtue of the tremendous risk and cost that was associated with it. And I simply want to remind, most of you know this, but in 2010, the fact is we put collectively the sort of financial centers of this world basically put up about 20% of GDP to risk, in a sense, in order to stabilize the financial system. This was money that was in some cases paid, in some cases guaranteed, whether it's through capital injections, guarantees, etc. So this is a huge amount, and of course it sort of culminated in the statement of the leaders of the G20 in October 2010, where they said, visible to the entire world, that they will do whatever it takes and they will not let any financial institutions or any systemically relevant financial institutions fail. And I think that sentence, that one sentence in the communique, really captures why, or to what extent, finance is special. Now, because of that, I think it's entirely normal, and you would expect it, that questions of rules, regulations, and behavior of the leaders of this industry is a focal point of our discussion, but also of our society and economies at large. In light of my personal experiences as both a public servant and a private sector participant before and after public service, I've thought a lot about both the rules aspect and the behavioral aspect of this. And you know, while certainly it's far too complicated a discussion to sort of put a simple framework around it, I would offer sort of 4 basic observations that might help us in our discussion today. And the first one is that the basic incentives in the system really matter a great deal. To me, the sort of most tragic lesson of this is that in 1996, the regulators, we collectively, introduced something called the Market Risk Amendment to Basel I, to the Basel I Accord. That amendment eliminated the need, effectively eliminated the need to have capital against the trading book, against trading positions. If you look at a chart of leverage in the system as a whole, that point was the starting point of the trend that directly led ultimately to the excessive leverage in the system that nearly brought down the financial system and by consequence the entire global economy. So I think this is a classic example that over a period of a bit more than 10 years, a simple mistake in setting the basic incentives made, I think, an enormous contribution to ending up in the terrible place where we ended in the fall in August 2007, now nearly 7 years ago. The second observation I would make is that we need to really focus on the basic incentives, and it follows from my first point. I worry that if we rely on a sort of intricate system of bells and whistles from a regulatory perspective, we end up in a game of cops and robbers. And it seems to me that a system that sort of relies on a game of cops and robbers is essentially bankrupt. Morally bankrupt, but also bankrupt from a sort of efficiency perspective. And personally, I worry that despite all the hard work we've collectively undertaken, under the leadership of Mark, of course, that we have fallen short by that standard. That in essence, we didn't do enough on the very basic incentive, in my mind, capital, and almost to sort of compensate it, you can think of it as a form of compensation. We're at risk of kind of developing a very complex regulatory bells and whistles system that will lead us precisely back to a kind of game of cops and robbers. So this notion that if we can't get the basic incentives right, it's going to be hard to get the right outcomes that we're looking for. My third observation would be that once we've looked at the sort of level of basic incentives, we then do need to look at the personal behavior of leaders. And I do believe, and David mentioned it in his comments a minute ago, that we do need a form of personal transformation of the leadership and the leaders in this industry. Now, how you get this personal transformation and what it actually entails is a very complicated question, and ultimately, hopefully, what we're here for to discuss. Kok Song has talked about other-centeredness rather than self-centeredness. That may be one way to describe it. But I do think that you really need a change. You need a refocusing on stewardship rather than simply maximizing wealth, personal wealth, and wealth of those that serve with you. So I think this notion of personal transformation is absolutely key. The problem is if you don't have the right incentives and therefore the right business model, I fear that if you end up with the wrong business model, at best you're going to have good people, transformed leaders who find it difficult to do the right thing, and that's your survey, shocking number. Or at worst, with the wrong incentives, you end up with the wrong business model that then attracts the wrong people into these leadership positions. So that you have a kind of an adverse selection process that would be the worst outcome. But even if you have the right leaders in the wrong system, under the wrong incentives, in the wrong business models, they're going to struggle to do the right thing. And I think that's probably largely where that number comes from that you've mentioned. Finally, my fourth observation would be that if we fail to address these issues, starting with the basic incentives, leading to the right business model, plus the personal transformation, I do believe the change is going to be imposed upon us, presumably in a way that will be counterproductive in terms of prosperity and growth. And it seems to me what you're seeing, both in the sort of populism, rise of populism, but perhaps also in some of the fines that we're seeing being levied against financial institutions, may well be a sort of early sign of a reaction that will be inevitable if the industry itself fails to address some of these issues. So my basic point today as a sort of starting premise is we have to look at this problem from below and above, if you like, the structure, the incentives, the business model, but also from a very complicated perspective of personal transformation amongst the leaders.
Great, thank you. Kok-sung, you've been in the industry for, I think, 40 years. How have you seen it changed, and how do you see these changes affecting this particular issue?
Well, I think ethical standards of behavior it's very difficult for those standards to withstand the temptations of greed that has, come to pervade the world of finance. But having said that, I would say that I don't think the leaders of the financial organizations, which had, in a way created this problem, I don't think they set out consciously to cheat, to rake the markets and to engage in misconduct or illegal behavior. I would say that probably there were environmental factors that contributed to that state of affairs. First of all, the very intensive creation of credit. I mean, what Philip alluded to, 20% of GDP being risked in trading in the markets. So there was this intensive creation of credit which provided great temptations for those in the money world to want to make a quick buck. And then I think there were perhaps structural changes in the ownership of financial organizations, particularly the investment banks, moving from partnerships, personal ownership, to a corporate form, where the downside risk, was sort of reduced considerably. And that put in motion, a situation where such investment banks were aiming to get bigger and bigger. So that's one aspect of it. The other aspect, of course, is the laxity of regulation that Philip alluded to in terms of the leverage ratio, that financial organizations were given considerable leeway to leverage up the balance sheet. And that itself created a problem because I think the financial organizations grew so big and so complex that it became quite difficult to manage those institutions, even in risk-taking, because the leaders at the top, in quite a number of cases, did not understand the risks that were being taken by their staff and do not understand the aggregate risk that the whole organization was exposed to. So there was that complexity. And then on top of that, we have a major culture change in these organizations. A culture change in the sense that there was this pursuit of short-term greed, instead of long-term profitability. And what did that spawn? I mean, that spawned a culture where, risk takers were being recruited, from all over the place. They were like mercenaries, being hired, and they were given the temptation to make a lot of money in a short period of time to perhaps retire within 1 year. So I think we had that kind of behavior, you might say a virus, that entered the system. And it became very difficult in such an organization for there to develop what I call a culture. Because a culture depends on the long-term relationship between employer and employee. But if the employer treated the employee as a mercenary, and the employee felt that at any moment he could be fired because he couldn't produce the profits, how are you going to generate a healthy culture? So I would say these are the contributory factors, that perhaps led to this problem. But having said that, I want to make the point that it is a big problem because this has led to the loss of public trust in finance. But it is a big problem caused by a small number of people. I think it would be wrong, to taint the entire industry. I think there are many people who work in the finance industry who want to serve their clients well. But although it's a small number of people, it is a virus. So unless we do something to check the virus, then we would not have gone down the road of improving the state of affairs.
Thank you, Kok Song. Let me now turn to the official sector. Managing Director Lagarde and Governor Carney, in addition to getting your views on what you see the source of the problem, I think we would be interested in knowing why this matters in terms of the discharge of your own responsibilities. At the annual meetings, we've seen, the IMF, the Bank of England, they've got a lot on their plate, a lot of urgent issues. How does ethics fit into this? Managing Director Lagarde.
Well, thank you very much, Sean. And I have some good news this morning, actually, because you gave us some pretty bad news number. And the good news is that the room on a Sunday morning at 9 a.m. is full. So by putting that on the agenda at the insistence of Sean, and I would like to recognize you, Sean, we made the right choice. And it shows that people are interested. They're interested in ethics and finance. They're interested in confidence. They're interested in trust. Now, why does it matter to the IMF? It matters for two reasons. Because of the very special role of finance. Now, I see many heads of international systemic, non-systemic institutions in the room, and they know what they're doing. They intermediate between lenders and borrowers. They transform maturity. They fuel and oil the economy. They fuel and oil the economy. That's where it matters to the economy. And the mission of the IMF is stability. Stability, prosperity. So whatever fuels and oils the economy is going to matter to us. Now, what is it based on? If we have heard nothing during the last few days with our membership, we haven't heard the word confidence. Confidence has been repeated over and over throughout the entire organization. from advanced economies to low-income countries to emerging market economies throughout all sectors. And I pay tribute as well to Mark, who as head of the FSB is really doing a fantastic job in pushing in the direction of more stability. Capital ratios, liquidity ratios, leverage ratios, and there's a big debate raging. But there's a fourth one, so capital, liquidity, leverage. The fourth one, which is critical, which is the confidence ratio. And on that one, whatever Mark does, whatever goodwill there is in the room, it's going to be a matter of building it, rebuilding it, consolidating it, and continuously working on it, because it builds over time and it dies overnight, as we've seen. So that's the reason why it matters to us enormously, because confidence, what we've heard in the last few days and that we know, then generates investment, which generates in turn growth and jobs, which brings stability, and you're in that virtuous circle that is so badly needed. So because of the specificity of the financial sector, and there is one specificity that I would like to finish with. In my view, the financial sector is also the custodian of public good. Currency, money, the creation of credit, that is a public good. And that's the reason why it has special responsibility and can create special risks. And my fear is that over time, and for factors that you have mentioned before me, the operators of trust have lost a little bit sight of their individual responsibility in the overall process, because it is so big, because it is regulated, because it's a little bit opaque, because it's highly technological and more sophisticated, and also because having lost a little bit sight of responsibility and the overall responsibility, as you were saying, there's also a little bit of having lost sight of risk, because risk is sufficiently subdivided, aggregated, reaggregated, transformed, and repackaged in such a way that we don't really know exactly who is bearing it. Now, we're making efforts in the direction of better identifying them and associating them with responsibility. But I think these two matters, where is the risk and who has the responsibility, are bottom line question that I think we need to continuously address, because it's a highly fertile and a very brain-powered sector where people invent and reinvent all the time.
So, Governor Carney, I mean, you've thought about this issue. Actually, you touched upon it in a speech you delivered, where you talked about this issue. Can you share our perspective, not only about why it matters, but where you see the source of the problem is?
Well, first off, thank you, Sean, for organizing this, and much has been said. I agree with all of it, so I'll just try to supplement it on source of the problem. One of the elements in the developments of finance over a couple of decades is it became much more transactional than relational. That's not a unique observation to me, but and we saw the manifestation of that in a couple of problems which were at the heart of the crisis. Think the originate to distribute model of securitization, where the relationship with the client was elongated, ultimately elongated between a money market fund, a SIV, asset-backed commercial paper, an investment bank that had originated or repackaged the loan, the underlying mortgage bank that had originated the loan, and ultimately the client that was serviced by a separate mortgage servicer provider. There's no connection between the provider ultimately of credit and the recipient of credit. And I think Christine just touched on that. Those elements of risk are then repackaged and restacked, and you lose that relation. Think about rigging of LIBOR. If you look at the transcripts, you look at the details of that, that's something that, of course, has helped prevent the confidence ratio from coming back up despite many efforts. You look at what happens there, which has to be punished, is being punished. These are a series of individuals who are totally detached from what the ultimate purpose of that benchmark is, that it actually determines the rate at which individuals pay on their mortgage or businesses pay on their loans. It's a game. It's a game between people within a square mile. So it's a disembodiment of finance, and it's a detachment of finance from the real economy, from its ultimate purpose of serving the real economy. And part of that is because of business model development, financial innovation, and that is a big thing to work against. And I think the challenge is that it builds on a natural tendency that we all have, which is to compartmentalize, to separate, job from home, strict legal compliance from complying with the spirit of the law, the regulation. So why does it matter? I think David touched on it in his remarks, and others have. It undermines trust in the system. Now, think of the levels, though, of that. It's not just between banks, trust between the institutions, investors in banks, creditors in banks. It's also between regulators across the world. That pulls the system apart. That threatens the good work of the IMF of having an open, global, and resilient financial system. And ultimately, the confidence ratio, again, it undermines trust in the system, and not just the financial system, because it's part of what erodes social capital. It undermines, or challenges at least, trust in the overall market system. So the stakes are very high. Now, a number of the issues I've touched on have been addressed or are being addressed from a technical regulatory perspective. I agree with Coxon, absolutely. The leadership and the vast, vast bulk of the industry is working to change. We're seeing some of the manifestations of that this weekend here in Washington. There's a major announcement out of the industry which will help end Too Big to Fail, which will come out, I believe, tomorrow, is my understanding. But there are limits to what financial regulation can do. I'll just touch on 3 or 4 things, just the headlines, and I'll let you drive the process. Clearly, ending Too Big to Fail is necessary to restore trust, a sort of heads I win, tails you lose bubble for the world's largest financial institutions has to end. I think Brisbane has a prospect of being a watershed moment there. Reform of compensation, essential to help align incentives between individuals and to have them bear the consequences. My colleague Manu Shafiq is here. Work on fair and effective markets, the structure of markets, and the codes around markets. That's also important. But I think the last one I'll mention, which goes to the heart of this issue, is there's a need to rebuild, or transmit across institutions a sense of vocation, a sense of being part of the system, a sense of being a custodian of institutions, a sense through time and across the economy. Because ultimately, finance is an intermediary. It connects individuals, institutions in the real economy to invest, to innovate, to grow. And it's that sense that is lost when finance becomes disembodied. And that, in part, is what we're working against.
Excellent. Thank you very much. So, Archbishop Justin, it's great to have you here. You really do bring a unique perspective to this issue. I mean, apart from being a spiritual leader, you're also someone with considerable knowledge on this specific issue. You served on the UK's Banking Standards Commission, where actually, from what I can tell, looking at some of the reports, a lot of these issues were discussed. So I'd really like to get your perspective on the nature of the problem, but I'd also be grateful if you could help us with, maybe it's because I'm a lawyer, a definitional issue, which is, when we think of ethics, the first thing that comes to mind is the idea of integrity and honesty. And clearly there were some unethical practices that are based on dishonest practices, deceptive practices, LIBOR, just avoiding sanctions, money laundering, also just misleading investors. But what I'm getting from the discussion so far is that there's a broader issue here, which is, because of the special place that finance has, when people act recklessly by building up the type of leverage, for example, that Philip was talking about, are they acting unethically? It's not being dishonest, but they're being reckless when the consequences of those actions have a devastating impact on the lives of others.
Thank you very much, Sean. Unique perspective, I don't know. I feel rather like a lion in a den of Daniels at the moment. So, slightly nerve-wracking. And I must say, having heard the market participants say what they thought of the banks, it makes me feel very mild about my comments in the past. As some of you will remember, in 2009, Queen Elizabeth II was asked to open a building, I think it was a new headquarters for some group of economists, which she'd agreed to do some years earlier. And the Queen is a very intelligent woman indeed, and she knows just how to ask the wrong question. And she asked what went wrong. And nobody could answer, so they wrote her a very long letter setting out the answer. And the letter basically explained things in terms of the kind of things we've been talking about: lending decisions, risky behavior, mispricing of risk, all the kind of things that we saw in the Banking Standards Commission. And the trouble with it was very good. It was a well-informed and thoughtful answer. But the trouble was, it was a bit like saying the Titanic sank because too much water came in. And I want to, in a sense, to answer Sean's question, step back a bit and ask what we look at. Because there were a number of extraordinary moments on the Banking Standards Commission, some very emotional moments. I remember one banker particularly, and this picks up a comment that Kok Sang said earlier, that a banker who'd been broken by the experience as an individual and was in great suffering and pain. We were very gentle with him. And at the end, I asked him, when you look back, as we all do, and I've run things that have gone dreadfully wrong, and most of us have, and you wake in the night and you think, if only I'd done this, if only I'd done that. And I said, well, what do you think? And he said, you can either have a big bank that's simple or a small bank that's complex. You cannot have a big, complex bank and run it properly. And I think if only we'd kept it simple. That it was a very poignant and powerful moment, because he'd thought about it a great deal. But I think it comes back to the question of ambition, of hopes, and of values that have been alluded to. And I agree with everything that's been said. What do we look at in our ambitions? I think from the 80s, when I was in the markets myself, and at the beginning of the derivatives markets, very involved in that, and oil, and involved in oil trading and futures and finance of all sorts. The change in culture moved people much more towards, as they always have been, but much more towards results, size, growth, complexity. It's very striking that if you look back at the history of ethics, that is an aberration. That the history of ethics should be around what you do as a virtuous person, not just looking at consequences, not just looking at rules, but as a virtuous person, that means that you are remembered as someone who contributed to the world in which they lived, and that your impact is beneficial. It takes you well beyond the personal and the individual. I remember years ago when I was in the finance markets, one of the clergy at the church I attended saying, what's an ethical group treasurer? And I said, oh, someone, I think it was something about not fiddling your expenses and sort of behaving reasonably honestly. He said, no, that's just a decent human being. What's an ethical treasurer? And that was about value. Recklessness, the nuclear parallel's been used, but I went in, I was working in Liverpool in 2008, running the cathedral there, and in 2011 up to the northeast of England in Durham. In Liverpool, we were living in a ward that I think was the second poorest in England, one of the poorest in northwest Europe. In Durham, it was the ex-coal mining areas. And we were surrounded by people in the utmost need. And then there was this catastrophe that came on top of that. Finance, as we've all said, is different. We are now 7 years into the crisis, 6, 7 years into the crisis, and there has been almost no recovery in many of these areas. A financial crisis is much worse than a recession, an economic recession. It so undermines confidence that everything grinds to a halt, and in the poorest areas, it grinds to a halt even more. And so it seems to me that at the heart of the reconstruction of confidence is a confidence in ethical and worthwhile banking that has at its heart ambition. There's nothing wrong with ambition. But in the past, before the crisis, the ambition was badly directed. An ambition for heroism, not only for internal rate of return, not only for meeting your cost of capital. Now, you do have to have that, because otherwise you disappear. But there must be much more to it, to a heroism in the classical sense, as it was seen in early Christian theology by Aristotle. If you read the Aeneid of Virgil, you see it very clearly there, that calls us to be those who leave a mark on the world that contributes to human flourishing. And human flourishing and the basis of the human being as something of absolute value is at the heart of, certainly in my own work and in my own belief as a follower of Jesus Christ, as someone who was relatively unsuccessful in pure output terms. He had 12 main followers, 1 betrayed him, 11 ran away. If you think of that in terms of a board of directors, it's not invariably...
It's not unusual.
...successful. But in the next 300 years, those followers so transformed the world that the greatest world power of the age was changed. Now, that's what we call output. So recklessness is part of ethics because it's impact. And a virtuous banking system is seen in its effect in Toxteth and Bishop Auckland as much as in return on equity. I think I'll shut up there.
Kok-san.
I think coming to define ethics, it might be useful to think of a hierarchy of values in regard to behavior. And starting with a human person, what is the right thing to do? What are the consequences for this person, the benefits as well as the cost? And then moving on to the organization, and beyond the organization to the system. Here we are talking about the financial system. But beyond the financial system, to society at large. So I think there is a hierarchy. And perhaps, as I was thinking about this issue, I came across a very moving story. I think it was told by Senator Sam Nunn. And it goes like this. So the businessman was rushing to his train at a train station in the big city. And in his rush to get to the train, he knocked over a table of apples which was being tended to by a crippled boy. And the apples flew all over the ground. The businessman was in a hurry to get to his train. He murmured, "Sorry," but he didn't stop. And he charged towards the train in order to catch the train. Another businessman came along and, seeing what had happened, stopped. and went down to the ground to help this crippled boy pick up the apples. And as he was doing that, he observed that the boy was not only crippled, but blind. Blind. So he helped the boy to put up the apples on the table, and then took out a $10 bill to give to the boy, and then he wanted to set off to his train. But he felt a tugging at his coat, and he turned around to the boy, and the boy said, "Mister, are you Jesus?" So I think that's a good definition. In other words, we have a spectrum. We have a spectrum, all right? Not to do harm to people, consciously or unconsciously. But there's a much higher standard, which is to do good. How do we bring that about in the finance industry?
Okay, that's a great transition.
To someone else.
That's a great transition to basically now looking forward. I mean, you know, as you have said, there are problems with the system that create bad incentives, but also there are problems with individuals that require transformation. So we need to perhaps explore both those topics, and I think we're all in the audience looking for some specific guidance on both aspects. So I'd like to throw this open, but I'd like to ask two questions, which any of you can respond to. The first is, you know, there have been a lot of fines levied against firms for a variety of things: LIBOR fixing, breaching sanctions, misleading investors. It's a long list. But very few penalties against individuals. And we talk about incentives. And, you know, ultimately, businesses don't make decisions, individuals do. So one question I have is, at some point, doesn't there need to be a greater degree of individual accountability? I'm not saying how that is done, whether it's through criminal, civil, or even compensation. I'd like to explore that, but at some point, don't we need to be talking about individual responsibility? That's the first question. The second one is, I think it's going to be helpful to talk about regulation, but I completely agree, and I want to develop this, the limit of regulation. You know, as I think Archbishop Justin said, you know, ethics is not doing the right thing because of carrots and sticks. It's doing the right thing because it's the right thing to do. I mean, I think Immanuel Kant would say that. A lot of other philosophers would say that. So if you focus only on the carrots and sticks, you end up developing a culture of compliance. And as we all know, you know, compliance is also about circumvention. So ultimately, what we're talking about is creating values, not compliance. So how do we create values? How do you actually go about doing that? And it's not just about organizations, it's about individual transformation. So those are my general questions I thought I would get out. But Governor Carney, maybe you can help us a little bit, because I know just on the system reforms, a lot has been done in the UK, and also in the FSB, there's a lot of useful work that's been done also on compensation. So maybe you can help us give some granularity on that.
Okay. Well, let's work from compensation towards, because clearly incentive alignment, I mean, we're a lot of economists in the room, a lot of business people understand the need for proper incentive alignment. And the experience in the run-up to the crisis, just to grossly simplify, it was referenced, large payment in cash for risks that were taken on by the institutions that had a much longer horizon. So the future was totally devalued, and the present was everything. The consequences of that were seen. Certainly the structure of compensation, the structure, not necessarily the level, we can get to that, but the structure of compensation contributed to the problem. There has been substantial reform to compensation practices. People can still take issue in terms of overall amounts. In fact, Philip wrote the first report for G20 leaders 5, 6 years ago. on this, and it's been developed and implemented, certainly implemented in the UK. Much more compensation paid in stock, which brings a longer-term horizon. That stock vests over time, which reinforces that longer-term horizon. An ability to cancel bonuses that have been given but not paid because of risks that come up that hadn't been thought through, or because of personal or group conduct that that individual contributed to, or that group of individuals contributed to, and the ability that we're putting in the UK and other jurisdictions to claw back compensation that's actually been paid out if subsequent to it being paid, material adverse behavior or effects are discovered. So that helps align incentives. But we don't for a minute, and certainly on this panel I wouldn't represent for a minute, that you can design the perfect compensation scheme that delivers ethical outcomes, broader outcomes. And to make it more technical and more in my direct area of responsibility, it's very hard to design compensation for systemic outcomes, to internalize financial stability risks to individual compensation. So you need something more. The second suite of measures are to establish much more clearly personal responsibility of senior managers, personal responsibility of members of boards of directors of financial institutions. If you're the chair, if you're the head of the audit committee of a financial institution board, the risk committee, you have a responsibility for the activities of that institution. And if you don't think you can discharge that responsibility because you don't have the information, Justin's reference of big and complex, or because you have too much else to do, or you don't feel personally qualified, then you shouldn't be on that board. But if you're on that board, you should take the responsibility for it, and that has been put in place. And that is a measure, just to be clear, that was adopted in the UK after very fulsome debate in both houses, and very thoughtful debate. It is the law, because it's what society demands. Last point. This all brings us closer to your second set of questions, because I think in the end, and I mentioned in my opening remarks, that we can align compensation, we can, in legal terms, enforce greater personal responsibility, but ultimately, it's about the individual seeing the broader sense of responsibility, understanding themselves as a custodian of an institution, internalizing some of the systemic aspects of their behavior, of their transactions, for their clients, for their society. And that's about where the FSB stops, and the more interesting conversation begins.
Thank you. So, Managing Director Lagarde, any further observations on both the balance of responsibilities in terms of reforming the system and individual accountability?
Well, I would submit, Sean, that any improvement of the system is going to rely on good regulations that are sufficiently harmonized across the board to cover also the systemic institutions that are cross borders by essence. Simple regulations so that people understand and that we don't commit the same sin, to sort of make it so obscure, so opaque, so complicated that people can hide behind by checking the box but really not complying with the general principles. Would include strong supervisors that are independent financially, technically, that have the resources to do their job, that are politically independent as well, and that probably requires conflict of interest rules and particular protection for them in order to be sufficiently independent. And on the issue of responsibility, I think that the clawback system that Mark has referred to is a good one. I think there is something that maybe has been tackled by the industry, but from previous life, I know that forensic accountants, for instance, are very capable of identifying the pattern of behavior of certain people. And I would submit that a lot of those individuals that constitute the small group of those that betray the public good and the general group of colleagues who mean well, there is probably a pattern of behavior which generally undervalues the future, focuses on the present, and leads them to spend short spans of time in various institutions and move from one to the other and to the other and to the other. And I think this is something that is worth looking at from a legal perspective to understand how civil and possibly criminal liability can actually follow those individuals, particularly based on that particular pattern. Now, two more points. Everybody who's been in leadership or management in the room would understand that. But I think that all these good principles will only be effective if there is buy-in at the top. And there are institutions where such buy-in actually demonstrates the adherence to the principles. It's not sufficient. It has to, the buy-in at the top has to enforce the standards and has to do it quickly, and sometimes by the little knife method, as I call it, which consists of actually applying the sanctions, including to your biggest earners, to your best traders, if there is reckless behavior. And I was chairman of a law firm, and I had to say goodbye to partners who were bringing in masses of fees, but the conflict of interest principles had not been respected, and we had to separate. And it's hard when a lot of money comes in, but I think it needs to be done. Fine. Two more points. Still on the good management principles, I believe that training is needed. If that world works on the basis of greed or fear, well, training is needed. And regular training. As you know, lawyers are trained on a regular basis. We have to constantly take classes, and it has to become second nature. Training has to be part of it. And final point, because behavior is not necessarily going to be sanctioned by penalties. We all need to have our Archbishop Justin, or our mother, or what I call our little Geppetto, so that sometimes we can say, what would Geppetto say to me? Or what would my mother say to me? Or what would Father Justin, or whoever you respect, whatever your faith, would say about that when I could do something without anybody knowing?
Thank you. So we've gone from the system, and we're going to get to the individual accountability issues in a second. There's one intermediate point that I want to touch on, because Kok Song had identified it, which is sort of the organization, right? Within the organization, which is important for culture. Philip, I know that the G30 has done some work on governance reform, specifically in this context, and maybe you can share us just very briefly what the work is and how is this relevant to individual behavior?
Yeah, the Group of 30 has published a report on this, and it takes up, I think, very nicely the themes that have come out of this discussion, namely that, broadly speaking, you need two things. You need proper incentives through proper governance. That's what I would call the top-down approach. But then you also need what the report refers to as culture and leadership coming bottom-up from the leaders of these businesses. And I think, the way I read the report and the way I think about it is the basic notion is in there that you have to have both. You have to have proper structure, proper incentives, proper organization, proper business model, and you have to have the sort of personal aspect, the ethical aspect, I suppose, that we're talking about here. And I worry, and I tried to allude to this at the outset, that we are still in a place, despite all the work Mark and his colleagues are doing, where the business models are still flawed, fundamentally. And perhaps the way you can think about it is, what does a good leader do if an ethical good leader, if he ends up in an industry or in an organization that basically has a flawed business model? You kind of face two choices. You can either radically change the business model, but depending on where incentives are, what shareholders expect, that might be very difficult to do, or you can sort of try to optimize within a flawed business model. So let me give you an example. If you are in the bank and you have a large deposit base, and you can use that deposit base to subsidize risk-taking on the proprietary side, even a very good leader, a sort of hero, to take the Archbishop's terms, he's going to be caught in a very difficult situation in that business model. He can, of course, be a revolutionary and sort of change and break the business model and rebuild it. But for various reasons, that may be very, very difficult. And then you're in the optimizing game where you try to manage the risk and sort of get around it, but it's very, very hard. Whereas if you're in a pure business model that has 100% a sort of fiduciary principle that does not have built-in conflicts of interest all over the place, it's a lot easier to be a good leader. And so it seems to me it's very important to step back and think about how do we create the starting assumptions or the starting premises, the starting incentives in order to encourage or perhaps enforce the right business model. Because I fear that with all the sort of emphasis on good leaders, if a good leader, if she ends up in a place that is sort of flawed as a business model, chances are she or he is going to fall short of the sort of hero in the antique sense or in the classical sense of the hero standing that the Archbishop referred to. So that's why, and it goes back to the Group of 30 report, I think this problem cannot be looked at just from a moral perspective or just from an organizational perspective or an ethical perspective, an organizational perspective. You really need the two things to come together. Now, the good news is, and this perhaps, Christine, reflects itself in the fact that the room is full on a Sunday morning, we are making progress on both fronts. The fact that increasingly leaders are reflecting on this and are focused on this. I suspect that in most organizations today, the time the leadership spends on culture and values has probably increased tremendously over the last couple of years. That's a very positive sign, sort of bottom up. And of course, top down, as Mark has mentioned, a lot is happening and has happened on the regulatory side to hopefully change the incentives to lead to the right models. But I guess my sense is that we are not there yet. We are still in a situation where business models are encouraged or perhaps even created or incentivized at least that make it very difficult for even a very good leader to do the right thing. So what I worry about is if you have a flawed outset, you end up in a situation where, as I said at the outset, at best, you have a good leader who's compromised, and at worst, the model itself attracts bad leaders. I would also I want to sort of mention one thing on individual accountability. I remember one of the seminal sort of memories I have, pre-crisis, I was a young central banker at that point, and would go to these events, sort of society events, and as late as 2006, if you had a big conference, the leaders of these banks that within 24 months brought my own country to the abyss, basically, or to the edge of the abyss. Those leaders would be assigned to tables, and everyone in society, including religious leaders, academic leaders, cultural leaders, were dying to get a seat at the table of the very same CEO that 2 years later was sort of branded as the villain of the country and the villain of the world. So I think we also have to recognize somehow the system as it existed pre-crisis led to a sort of collective dance around a set of values that turned out to be fundamentally flawed. And so we have to be, obviously, and Mark said it, a lot of countries, the UK perhaps first and foremost, are moving very quickly towards this, and it's correct. It's the right thing to do, but we do have to remember that this was not just the problem of sort of rogue individuals. You had, I would say, large, very significant segments of society were in on this and were part of it. And the sort of struggles to get a seat at that table where the big banker sat as late as 2006 is something that I remember very vividly. So I think we all have to be introspective about this and recognize that this was not just the failure of individuals, as Kok Song has pointed out at the outset, but it really was a collective failure of society at large.
Introspective. I want to just focus on that word a little bit because Archbishop, Justin, I'd like to come to you a little bit about the issue of individual transformation in this creating, as Kok Song has written, about other-centeredness and the basically leaders being able to move beyond the ego. You were interviewed in the Financial Times recently, and you spoke to this issue, and in fact, I think you've established a quasi-monastic community for financiers. You want to talk a little bit about this, and what sort of take-up have you had? And could you give us, how is it structured, and how do you approach this? I mean, this is a long-term process, I would imagine.
Very long term. I think I just want to start by saying how much I agree with what Philip just said. Again, going back to the Banking Standards Commission, there were two things I used to sit there thinking as I listened to the evidence. One was I'd have done the same as them because of the force of the culture. And the second was, I wonder what I'm missing in my own institution. It's very easy to look at someone else. So I think we have to be very careful about the judgments we bring. And I try and be careful not to express judgment, not to judge, because I'm quite conscious of the flaws in my own system and character and personality. That's one thing. So I think what Philip said was very, very helpful. And I can remember in many, many years ago, in one of the last things I did in business, middle of the night, in the middle of a big deal, which I was leading on, making a decision that was clearly wrong. It wasn't illegal or anything like that. It was just a shortcut, but it was an improper shortcut. And the bank we worked with happened to be S.G. Warburg, which had a very strong culture. At the time, one of the bankers saying, we don't do it that way. And, you know, that's culture eating process. And it was healthy. So I just want to say that to start. I think in most areas of life, we accept, in the crucial areas of life, that inner motivation is incredibly important. If you were going to have an operation, you knew your surgeon had no inner motivation to do with healing, I think on the whole, you'd probably try and switch the person who opened you up. And we take that for granted, it's obvious. And it's part of the way that doctors or other professions are formed. And so why is it not so true when it comes to financial services? Because what we're talking about here is the how, not the what. And again, it's very easy to say what should happen. It's very difficult to say how it should happen. Christine spoke of that a few minutes ago, and I think very wisely. It's, as another of my mentors used to say, it's very easy to say what we should do. It's quite difficult to say what we should do now. So I want to suggest two things that we can do now. And they're both about self-reflection and education. And one's short-term and one's long-term. We've talked about the need for senior and middle-ranking leaders across the industry to make time for reflection and thought that is not publicized but is genuinely engaged with changing institutions. I know a number of people already doing that. I suspect some of them are here. And I also know from talking to them privately how much of a struggle they're having within their own institution. It is very difficult and painful to change culture. But failure to change the culture of leadership in the next 5 years to a degree that is unimaginable today, let alone from 2008, means that we will end up with a financial services industry that is overregulated, that is risk-averse, and therefore cannot, as Christine said earlier, provide funds to the places that need it most, that can't oil the economy. And we've begun to hear signs of that. And we need to be aware of that. So the first step, I think, is because in the end, your diary, if you look at anyone's diary, it demonstrates their priorities. It's a self-examination in time. We need senior leaders, and we need the scope for them to get away, and middle-ranking leaders, the next generation as well, to find time for really rigorous, self-critical, and painful self-reflection. And that needs to be organized, and organizations like my own can make space for that, and we need to do that. But the second is a long-term thing. Culture is formed over decades. We can do good stopgaps, but in the end, we need something more dramatic. And one of the things that Sean was referring to, I live, Caroline and I live in, I need to say, a small flat at the top of Lambeth Palace. So we live in a palace. You know, following Jesus, one is hooked on poverty, of course. Yeah, I feel guilty about it, but there. We live in one corner of it, and it's a wonderful place. It's a historic place, goes back 800 years. What we're trying to do over the next year, and we seem to be going well, is turn it into a community where, or start a community there where people from 20 to 35 will come and spend a year, and I'm beginning to think we need some space for, I mean, you're all obviously under 35, but there may be people in the room who are a bit older. But people 20 to 35, really bright people who will be leaders of the future, come and spend a year drawing on the riches of the Christian tradition in three ways. First of all, a balanced life of prayer, of study, and of work. That's the Benedictine tradition. The Ignatian tradition of intellectual self-examination, rigorous and painful, and setting values, and the Franciscan tradition of encounter with and service with the poor. We are changed most, in my own experience of my own ministry as a priest. What changed me most was encounter with the poor. And I learned more there than anywhere else. It's a sort of cliche thing to say, but it had an impact as a curate, as a newly ordained priest who thought I knew everything. They spent a year studying ethics, philosophy, working very hard, a routine of prayer, and working with churches in London and around the United Kingdom and Northwest Europe that are working with the poor, and also internships elsewhere. We're calling it the Community of St. Anselm. They'll live in community in the palace. It will be uncomfortable, demanding, rigorous, tiring, and I hope it will set them in a way of thinking. So in 20, 25, 30 years, when they're leading countries, industries, armies, even churches, that this will be the thing that has shaped them internally to deal with the systemic issues that Philip and Christine and others have talked about, because the business model point is so important. Bad business models corrupts good people. That always happens. And so, no pride on my part, but I think as an organization, the church can make a difference here. I think we, on the whole, senior leaders can't take a year out, but maybe they can take a week or two. And we can do stuff with them as well. But it's trying to set a pattern that reboots the inner value system.
Can you also tell us whether they will find enjoyment? Because
yes.
what you describe seems, you know, and you've gone through a similar process yourself.
I went through a very similar process. Yeah. I can tell you, if you've been running a big department of a large oil company and you go to be a trainee in a seminary, followed by a curate in a parish on the wrong side of the track somewhere, it's really uncomfortable. But yes, it should be at the heart of Christian faith is a sense of enormous joy and recognition of one's place, one's call, one's vocation, one's purpose, one's value. So yes, thank you, Christine. Thank you. It'll be fun, but painful fun.
Philip.
By the way, it just occurred to me, demanding, rigorous, uncomfortable, and tiring sort of sounds like being a central banker during the crisis.
Where do you think I get the ideas?
Kok-Son, you've written about this, about the importance of developing a contemplative dimension in your life. Is this something? Do you have any advice to give on how to do this in a structured and practical way?
Well, I was fortunate about 25 years ago to be led to a discipline, a spiritual discipline, which involves me taking 25 minutes in the morning, 25 minutes in the evening to meditate. And essentially, I think it's about going to the center of my being to discover the moral compass, the values by which I operate in the world. And it's a process where you learn to gradually become less and less self-centered, more and more other-centered. And I think particularly in the money world, in the financial world, in most societies, traders, brokers, and bankers are held in relatively low esteem. And this is not a recent phenomenon, Yeah. And so we have to think about why that is so. Why are people in this profession so susceptible? And that's the reason why perhaps I think the earliest coinage had two symbols. A secular symbol on one side and a religious symbol on the other side. I think it is to remind us that all of us live, you might say, in a two-natured world. Two-natured. There's the world, the material world, the world of money, but there's also the spiritual world that we are part of. And for that reason, I think it was Jesus who said, "Render unto Caesar what is Caesar's, and render unto God what is God." So I think societies and cultures have to sort of make a choice. What are the truly important values that we want to live by? And I feel that the kind of work that you are doing, this community of St. Anselm, I think it is essential. It is essential because it's so easy for us, to dwell in the money world and lose sight of the higher goals in life, the spiritual side. But it's not easy. It's hard work. But I have found that by undertaking this discipline myself, it has kept me on the straight and narrow because, I could very well have gone down, the wide and challenging path. So I very much like this idea that you are propagating. And interestingly enough, on Tuesday morning, I'm going to speak to a class of second-year MBA students at Georgetown University, where my friend, the Benedictine monk Lawrence Freeman, is doing a course on meditation and leadership. And he has invited me to go there and share with these second-year MBA students, out of the experience of my corporate and personal life, how that has helped me to operate in the material world. And so I very much look forward to the opportunity to share with these young people.
Okay, well, thank you very much. I think it's time for us to open this up to the audience because I have a feeling that they want to participate. So please raise your hands if you have questions. I would ask that you would identify yourself and your affiliation. Also, there is a survey that is going to be circulated that we would be grateful for you to fill out at some point. So maybe we can take questions in groups because we don't have a lot of time. The gentleman right here, yes?
Thank you. I'm Atiur Rahman. I'm the governor of the Central Bank of Bangladesh. So I enjoyed these discussions you had. I agree with most of them. But I only can feel that, one of the sources of the global financial crisis was because of our focus on the short-termism, which many of you have brought in. And I thought, many of us who come from developing and low-income emerging countries, we spotted this earlier and went back to really how to make it, so that we really touch the ground and we start from the ground rather than creating liquidity which is not touching the ground. The growth which you have generated through leverages and all that, are mainly, lacked the motivations for environmental, stability, and also the urgencies for equitable kind of growth process. So what we did in Bangladesh, during right from the 2008 onwards, we really went straight into the kind of inclusive and socially responsible financing. And you'll be happy, and we have motivated most of the leaders of the financial banks. In fact, I, as a governor, I took all the CEOs, both public and private and foreign, for a roadshow for days together to tell them that we got to really touch the ground, work for their agriculture, SMEs, and environmentally sustainable projects. And as of today, 30% of the local loans now going to this bottom of the pyramids. And you will be happy to know as many as 13 million bank accounts have been opened only for 10 cents accounts, we call it, so that the ordinary people can get access. Even the street children, now they are getting bank accounts. About 1 million school children, they have a bank accounts, and they are saving and they are going there and working. And in addition, we have been able to really motivate the chief of the bankers to really take long-term view. As I said, our horizon as a regulator and also many of the financial leaders, very short. We really don't have a long-term horizon, and it's only possible if we go for the green kind of approaches, new approaches. And for that, I think we need a new client base. So if you have more client base, you are more secure, you're more stable. If you have more depositors, you have more secure deposit base. If you are more lenders, all of them will not fail. So I thought it's high time that we reorient the motivations of the bankers and also the industry so that we go for enhancing institutional kind of motivations for stability through inclusive and socially responsible financing. I thought, Tagore said, and let me end with that it's not the lack of money which is a problem. I think it's the lack of trust or the confidence. And I think as regulators and the financial leaders, we need to transmit these values that, we need to bring together. If you are alone, you cannot do much. But if 5 of you together, if you develop the relationship. I think our time is to build that relationship, and as some of you said, and go to the grounds. Thank you very much.
Thank you very much. If you could try to keep some of your statements short so that everybody can participate. Yes, there. A mic over here.
Stand up. We'll see you.
Eduardo Vassimon, Itaú Unibanco in Brazil. My question is about alignment of incentives. Some countries, few ones, have rules establishing that directors of financial institutions have all their net worths at stake. So that if the institution they manage fails, they lose absolutely everything they have. So maybe helping the little Geppetto Madame Lagarde mentioned to be more active. My question is, what do you think about this type of legislation and why so few countries adopt it? Thank you.
So maybe we can have some reactions to the first two questions, and I thought, Mark, you had some other general points you wanted to make.
Yeah, maybe last chance to say something. So let me make a general point first, which is actually there is great joy in being a central banker, despite all those four elements. I get to be on. I get to come to this panel for one thing. I've learned a lot. But when you think about the mandate of the Bank of England is to promote the good of the people of the United Kingdom. How can you not feel good about yourself coming to work to try to, and provided you remember that that's the objective. Part of what we're talking about here is what is the broader objective of people who are working in private finance and motivating them and them recognizing, just as I hope everybody, all the 3,600 employees of the Bank of England recognize that they contribute to that broader goal, and it's important to have that broader goal. So that's a general point, and part of what we're trying to do through the Banking Standards Commission in the UK, through the Fair and Effective Markets Review, through working with industry, is to create, driven up and developed by industry, that sense of broader responsibility. Okay, I'll answer the question about director liability. This is something in Brazil, it's something in Turkey. Countries that have had a series of financial crises, banking crises, until they put this into place. It's obviously the extreme level of incentive alignment. It does work. It does focus the mind of directors. We are not, as it should. I would like to think that with the level of direct responsibility that we're putting in place in the UK, for example, that the minds of directors are being focused. Some of them might not like it. That's okay. They have other things to do. But those who want to take on those responsibilities will come. So obviously we're not moving all the way to that. But a sense of personal responsibility for the institution that comes with it reputational and other consequences. The fact of the matter is, one of the unfairnesses, and I'll stop here, one of the challenges of the crisis, one of the legacies of the crisis in the US, by and large in the UK, other jurisdictions, the individuals who ran the institutions got away. They got away with the compensation packages, they got away without sanction. Maybe they weren't at the best table in society after that, but they were still the best golf courses, and on and on. So that has to change. That's an extreme way of doing it, so I recognize it.
Thank you. Some more? Yes, gentleman over here.
Davide Serra from Algebras Investments. I have a question for Philip and Mark. You both, a central banker, added contingent convertible as a way to align interest in large, complex financial institutions. Basically, if management fails, they get wiped out because suddenly new bondholders become equity holder, and so there can be a legal change in terms of management and accountability. Do you believe that the issuance and development of this market will make the system safer and more aligned in a complex world, particularly for large financial institutions?
Let's take any more questions here. Over here, yes. Oh, it's kind of dark back there. I'm sorry. I'll get to you in a second.
My name is Marcos Freitas. I'm from Brazil, and my question is to the Reverend. The decline in religion all over the world, how does it affect the sense of ethics? And how do you see this impacting everything that we are talking about? Thank you.
Okay. Okay. You want to go first?
Not a lot, but I will. I don't entirely accept the premise of the question. Religious observance, certainly within my own faith, is growing in many, many parts of the world. It's just looking rather different. There's been a decline in religious observance, most emphatically in the most economically prosperous countries, and also among those groups within those countries that are in finance and business and commerce, and that is unquestionable. And I think that has had an impact because it takes away both the sense of eternal responsibility, but also the kind of thing that Koksang was talking about, the growth and development of the spiritual disciplines which make us whole people. And that leads to a short-termism. Just picking up something that was said earlier, that short-termism is something that's been reflected on a great deal, and that comes very often from a lack of anything that anchors in us in a long-term perspective. And that comes partly through meditation and reflection. And I think it's also the importance of senior leadership groups going away and reflecting on what their business models and their structures take them to in terms of their horizons. One of the things I particularly wanted, just from a comment earlier from the governor of the Central Bank of Bangladesh, technology is not ethically or morally neutral. High-speed trading may take nanoseconds, but it has a very clear impact. And if your business model involves the use of technology with that kind of impact, that is not morally or ethically neutral, and that is something that only a group of leaders can see.
Right. Philip and Mark, you want to answer?
Okay. I'm just prompted to say something as a follow-up to what you said and which I agree with. Equally, technology can be an incredible enabler of very moral purposes and causes. And if I look, for instance, at the efforts undertaken in Bangladesh, but also in India and other places where inclusive finance is a goal, technology can be a fantastic platform. Yeah.
Absolutely
okay. Good.
Yeah.
We agree.
Very quickly on the question on contingent capital, absolutely agree with the premise of the question, particularly if management is paid in wipeout contingent capital, so their deferred compensation. This really reinforces incentive alignment, and some firms, some of the better firms have done that. Quickly take the chance to make one other point, which is one of the big reforms that will come to a head by Brisbane in the next month is to broaden this out. Bail-inable capital, so-called TLAC, the acronym of the week. I want it to be acronym of the week here at the IMF. TLAC, which will mark a watershed for ending too big to fail. And that changes incentives. That changes the system. That focuses the mind. And that's something that's the product, and give industry credit here, it's a product of joint work between the public sector and industry to help move this forward.
Yeah, if I can just, Jean, very briefly add to that, I agree for three reasons. Two very good ones, one perhaps not such a great reason. First one is the one you mentioned, namely that it's loss absorption in the event of failure, additional loss absorption. The second reason, I think perhaps even more important, and it goes to TLAC, is that as you get closer to a problem, it focuses the mind. Because if management knows that you're going to get bailed in, particularly if it's in the form that Mark just mentioned, that focuses the mind on reacting preemptively. I always felt too much of the focus was on death and not enough on avoiding death in this whole context. The third one, frankly, I don't feel so good about, and it goes back to what I said at the outset, is to some extent, perhaps I shouldn't say this, but some of this was basically a response to the fact that we realized politically, I'm talking about Switzerland, I don't want to generalize this comment, that we couldn't push through common equity, sufficient common equity to really have full loss absorption, that it was simply too difficult to get to the levels that I felt were needed. And so to some extent, the convertible story, it was a bit of a second best option, that you do something that hopefully you can get through in the sort of broad political context that I think does have very positive features, but on a number of fronts, and I want to get into details here, probably falls short of what pure common equity would do as loss absorption.
Great, thank you. Two final questions. The gentleman at the very back who's standing up, and the lady sitting down in front of her.
Yes, good morning. My name is Alejandro Lara, former World Bank employee. Worked for the bank for many years. Actually, let me say something. I came from the second floor, which is fully packed with colleagues that they don't have the power of the microphone, unfortunately. personal responsibility should be also fully accountable, and I fully agree with him. There is something missing on the equation. It's also protection, because sometimes we can have, we can be personal responsibles, but there is a fear to move and to move up and bring issues up on the table. There should be. I would like to hear from the corporate area and from the international organization perspective. What are about the mechanisms to protect whistleblowing individuals? Because there is an additional ingredient added to the on the working for international organizations, that people come here to DC in this case. They come on a working visa, on the G4 status, and they actually feel that they could not or they cannot move and bring issues up, unethical issues, because their fear, there is a lot of fear to lose their jobs and to be retaliated against. So I would like to know, I would like to hear what are the mechanisms that are running or going on at a corporate level, and hopefully from the international organization perspective. Thank you.
Thank you. And the final, and could you make it very brief, please?
Thank you for allowing my question. I'm going to give you an alternative point of view. Even in the best of systems, the best of drivers, the best of pilots, the best of decision makers fail. So my question is really about the role of human error. So, in theory, we know we have adverse selection and moral hazard, and this is not a new problem. This has been going on ever since human beings have been around. We also have new theories on human error, which Kahneman and Tversky and others have talked about. So the cognitive architecture we have is filled with cognitive biases. So when you talk about personal responsibility, and it's an honest human error, let's just take one example. Tim Geithner made a decision not to save Lehman Brothers. He had lots of information. We are now hearing there was a report from the legal team that never got to him that the Fed could have saved Lehman Brothers. But he didn't. Ben Bernanke didn't. Hank Paulson didn't. Now, are we going to say that, in hindsight, they made mistakes? Or the system was so overwhelming at that time that mistakes were bound to happen? Best of drivers crash, even in the best of systems. So how are you going to handle this issue of human error? An alternative argument to thinking about personal responsibility.
Thank you. Okay. So that's it. So I'd like to turn it, we don't have a lot of time for responses. I just want to take myself one aspect of the question on international organization and whistleblower, just to say that this is something that was actually recently discussed extensively at the IMF, and we actually have now an anonymous hotline. We have an ethics advisor who addresses those issues. I think different organizations handle it differently. I think the one that we've put in place in the fund in the last few years is working pretty well. But the issue of human error, any?
Well, okay, very, very quickly. Whistleblower, you can talk to Doug Flint, who actually is the chair of HSBC, who's running an industry-led initiative on whistleblower. He hates the term because he wants people to react more quickly. On human error, and I'll make a second point on that, actually, for recognizing actions that are inconsistent with the ethical standards, I think actually getting codes for markets so market participants can recognize, they don't have to make an Aristotelian determination. They can look at how a market should function, and if there's a problem, then they can raise with senior managers. Human error, absolutely, there'll always be mistakes. I don't want to debate the Lehman situation, but the issue is whether individuals have taken reasonable steps, have made efforts, have thought about the issue, have moved. We're always going to I make mistakes every day. actually. Is this public? that was another one. Make mistakes every day. Big Carney makes mistakes. Every day I make a lot of mistakes.
We all do.
We all do.
Hopefully the journalist will be ethical and put it in context.
But I make reasonable efforts to avoid those mistakes. Sorry, I'll stop.
Any other?
And I ask for forgiveness.
So, there you go. So I'm not going to try to sum up. What I'm going to try to do is to go around and ask each of you if you could recommend one thing, one practical thing that you think would make a difference on this issue. What would it be? Philip.
More capital.
Well. Coxon.
I think external regulation must be accompanied by self-regulation. And by self-regulation, I mean the human person, the moral compass within. And to do that, you have to find some kind of a discipline. And I think there is a discipline in all spiritual traditions that you can access in order to develop this self-regulation.
That reflection to be holistic in terms of looking at a whole organization, a whole system, and therefore by groups who are honest and trusting with each other. That requires a level of community.
Thank you.
More women.
Mark, I had to follow that. I agree with everything they say. A code developed by the market that market participants can understand.
Okay. With that, let me please join me in thanking our panelists for what I thought was a great session.